Hi there, welcome to another live webinar with us from Phillip Nova. This is Sri, your facilitator of the day. What will we be covering today? We'll be discussing a guide to uncover a wealth of opportunities with the China A shares. As you know, the China mainland market A shares is currently trading at low valuations compared to major market peers such as the US, Europe, and Japan. Given its growth track record over the past few decades, its relatively low correlation to major equity markets, allowing for portfolio diversification, and the above mentioned increased likelihood for government playing a more active role in boosting the market through various stimulatory or supportive policies, it could be a very good time for us to put China A shares back on our radar. And as you know, in the late March 2024, Phillip Capital Management partnered with China Universal, a leading mainland China fund management firm, to launch our first China ETF. It's the Phillip-China Universal MSCI China A50 Connect ETF, which invests in a selection of 50 leading mainland-listed Chinese companies across a range of industries. The ETF has the lowest management fees of China-focused equity ETFs listed on the Singapore Exchange, and today we invite you to dive deeper into the recent events such as regulatory reforms, tech advancements, geopolitical developments, and understanding how they can influence the Chinese market. With us in the studio, we have Tan Teck Ling, who is the Deputy Chief Investment Officer for Phillip Capital Management Funds. And Tan Teck Ling is a key member of the investment team covering global equity and fixed income markets, including both active funds and ETFs. He oversees the managed account portfolios and the management of the equity and balanced funds portfolios. Prior to joining the group in 2008, he worked in the aerospace and defense fields with a Singapore-based engineering conglomerate and had project management experience in regional construction and infrastructure engineering consultancy firm. Teck Ling, before I hand the time over to you, let me just do a quick poll to see if our members of the audience can hear us. If you can hear me loud and clear, please let me know via the poll. All right, great. We've got a resounding yes, and okay, I'm gonna close the poll. Teck Ling, if you're all set to go, I'm gonna hand the time over to you. Teck Ling, please.
Thank you. Thank you, Sri. Thank you, everybody, for attending this webinar today. I assume that everybody can hear me loud and clear, right? Do let me know if I sound, there is some problems with my sound or anything, any points, okay? If not, then I will proceed right into the presentation itself. Today, as Sri mentioned, I am going to be talking about this ETF, which has actually just recently launched in late March this year. It's focusing on China A shares. So today I'm going to be talking a couple of things. So I will share with you what is the agenda for today. Yes, so basically I will give you an overview for the case for China A shares. So why China and why A shares, right? So for those of you who are not so familiar with A shares, basically that's the mainland China, the shares that are listed on the mainland China equity markets. So it's not talking about Hong Kong. Hong Kong is offshore China, right? So A shares is the domestic mainland China itself, right? Listed on mainland China, okay? Why that? Why A shares? Okay, I'll cover that in more detail later. And then I will talk briefly about the ETF that we have just listed, as you saw on the title slide just now. I will talk about the underlying benchmark index that this ETF, as all ETFs do, they track a benchmark index, right? So therefore, the index is very important. I will talk through the index, which is the MSCI China A share A50 index, right? I will talk about how it works, right, and the track record compared to other China-related equity indexes, right? I will talk a bit about China Universal Asset Management and the so-called Master ETF, right? And the reason why I'm going to be talking about this is basically this is a so-called feeder master structure. So basically the one that we just listed in Singapore, it's going to be primarily invested into a so-called master ETF listed on mainland China. So that's how it works, right? It basically buys just one position, right? That main position is the master ETF. So I will talk a bit about that. Of course, this master ETF also tracks the same index, and therefore our feeder and will also track the same index and perform similarly. Okay, right. So without further, okay. So basically, after covering all this, I expect to be having about say 15 to 20 minutes for Q&A, and we probably target to finish in 1 hour's time from here. Right. So at any point, probably I think if you're able to, you can just type some questions in if you have any, or you can leave it to the end, right? Since I'll have some time for Q&A anyway. Okay, so let's proceed, right? Quite a number of shares, a number of slides to cover, right? But first of all, I think the first thing that we must talk about is why China. Asia. When we talk about China A shares, I think first of all we must go top down. Why China in the first place, right? And of course, a lot of people have been a bit spooked by China shares, the China economy over the past few years. Why spooked? Of course, you read about and you hear about all the gloomy headlines about the China property market and the big drop in, and some of them even going bankrupt in some of the property developers in mainland China, right? Over the past few years, you've heard about a slowdown and so on, right? So that gets you a bit worried about whether is it a why China now, right? So I will talk about some of the underlying strength of China and also why now, the timing itself. Well, first of all, I think I would like to share with you the track record of China. First of all, on the left-hand side, the chart, you will see that the contributions to global GDP of China and the US over the past few decades, from 1960 to 2010, the past 50 years, right? So this is a really long-term story. The top part is basically China, the red part, the contribution of GDP to global GDP. So basically, you can see that it was as low as less than 5% definitely during the 80s to 90s, for example, and that has increased, rose very fast over the past few decades. And today, the Chinese economy comprises about close to 20% of the global GDP. The bottom part in blue, for comparison, is the contribution of the US to the global GDP, right? So as you can see, US has been, of course, a developed market, so grows more slowly, but China has been an economic success story, one of the miracles of the past few decades, for being able to bring hundreds of millions of people out of poverty, right? So the key for describing this is basically you wouldn't really bet against China given this kind of track record, right? And this right-hand side basically shows the GDP, but you adjust it for purchasing power. So PPP, so-called PPP adjusted GDP. What is purchasing power adjusted GDP? That means adjusting for the currency, the purchasing power of the currency in the respective countries, right? How much a unit of GDP is able to buy a given amount of goods, a basket of goods, right? So you adjust that GDP based on that adjustment. China is already the largest in the world in terms of purchasing power adjusted GDP. That means that amount of GDP that China is producing annually is able to buy the largest amount of goods in real forms when compared to the other countries in the world, right? So if you look at this chart, the red one is China, and the orange one or the brown one is the US. So since 2016, I think, since 2016 onwards, China has basically passed the US when you adjust their respective GDPs for purchasing power, right? So as I mentioned, the reason for showing this slide is twofold. One is that basically you wouldn't bet against the ingenuity or the energy or the track record, basically the long-term track record of a country like China, since it has been shown to perform over the past few decades. So possibly it may be just a blip in this current environment that you are seeing, this kind of slowdown, right? Of course, it wouldn't. I guess it wouldn't probably grow at the kind of rates like in the past few decades, but you know, it is still, you wouldn't. You already have a, which brings us up to the second point. Basically, you already have a critical mass of domestic consumption power within the country itself, by virtue of the fact that it's already contributing 20% of the world's GDP. So there's already domestic consumption power. So when China right now, they are trying to transition from export-driven model to a so-called dual circulation model. By dual circulation, what it means is that they are trying to drive towards twin growth engines for their GDP, for their economy. One is still exports, and the other is internal domestic consumption. Well, there's already a critical mass of purchasing power. So I would think that there is quite a good chance that they can succeed in driving the domestic consumption as a second engine of growth. Right. So that's one thing. I also thought I would show you this slide, which gives you an appreciation for the size of China's capital markets when compared to peers globally, right? And especially the stock market size, right? On the left-hand side, the chart shows the global stock market values by country. That means based on the total value of the stocks listed inside the respective exchanges, right? That is shown here. It is not surprising the US dominates the list, right? So you know, for example, in the NYSE, the total value of the stocks listed inside the exchange is about 25 trillion US dollars. But if you rank them down in descending order globally, right? So China already has two exchanges. Both are the domestic exchanges of China, Shanghai and Shenzhen. So two of them are already within the top 10 stock exchanges in the world, based on the total value of the stocks listed inside them, right? Shanghai plus Shenzhen together is about $10 trillion US, right? Right-hand side, another variation of the illustration. It's basically this number, which is the total stock market value of the stocks listed within as a percentage of GDP, right? The one in red shows for China, so the one in brown for the US. So what you can see here is basically that for China, the total stock market value of the stocks listed inside the domestic exchanges is still below 100% of the GDP. Whereas the US is a relatively more mature market. That number is more like 200% of GDP, right? The key thing to note here is there's still more room for growth for the China stock markets, domestic stock markets, in terms of this number, right? And how will it grow? Of course, one possibility is that, of course, if the total number of companies listed inside the exchanges remains constant, of course, they might appreciate in value, right? So that's one way to grow. Another way, of course, is that you have new IPOs as more and more domestic companies list onto the exchanges. That's probably how typically the stock market as a percentage of GDP rises as a country moves towards more developed status. Diversification benefits, right? So it is a key reason why a lot of institutional investors actually look at the China A shares market as a key part or strategic part of their portfolio. Firstly, there is of course, there's a critical mass of globally competitive listed firms within the various strategic industries within mainland China. They are already listed on the China A shares exchange, right? So you know, if you want to invest into the into stocks other than those very popular ones in the US, right? You have leading companies globally leading companies in the mining field, in the renewable power field, in the electric car field, right? All these, a lot of them are actually listed in the mainland China market. Secondly, of course, is complementarity, because the China A shares actually has low correlation with other global developed markets. So it offers portfolio diversification, right? You know, if you have a portfolio where all the key parts of the portfolio are all moving in the same direction at the same time, right? That's of course known as poor diversification. Right? If you have a portfolio where, you know, different key parts of the portfolio are moving at different cycles, right? Then we will say that the portfolio diversification is quite effective, right? And the way to measure is the correlation. When the correlation is 100%, means that they are perfectly correlated, means that they don't offer much diversification benefits. When this number is low, like for example, close to 0%, then you will say that the diversification benefits for that market to the portfolio is quite high, right? There's good diversification benefit. So for that, if you look at the China A shares, which is the last row for this table, MSCI China A, you will see that it is quite low correlation versus the other key markets shown here, right? Versus the US 14%, versus UK, versus France, versus Germany, versus Japan, all below 30% for the index correlation. Right? So we would say that there is good diversification benefits for investing into China A shares. Valuation, I think it is something that a lot of people do appreciate, right? And here I just show it in more comparison against the various other markets. The red line is basically showing China A shares, right? And the vertical axis is basically the PE ratios of the major markets. Needless to say, the US is one of the highest PE ratio markets globally. Japan Nikkei is also above 20 times PE, right? So if you look at China, probably it's one of the lower ones, right? So I actually have two China indexes shown here. One is MSCI China A. So basically this one is it captures the bigger China A shares market, thousands of stocks, right, inside the MSCI China A. The red one is basically a selection of the 50 stocks. This incidentally also happens to be the index that I'm going to be talking about for ETF later. Right? So that's trading below 10 times. Yes, all that is, well, I think a lot of people can appreciate that, right? China's strengths, fundamentals, valuation is low. Now, a lot of the narrative over the past maybe 2 years or so has been focused on, you know, since China is growing so slow, is the government going to be active to take some steps to boost the economy, right? Because you know, it is effects that the China economy is slowed down, right? It used to be, you know, that their GDP was growing at close to double-digit year-on-year, double-digit percentage year-on-year. Then after that, over the years, I think late 2010s, slowed down. The target for the government then had become more like between 5 to 10%, and then, you know, over the past 2-3 years, people were even worrying about whether that 5% number year-on-year GDP growth is even achievable, right? So a lot of the narrative or what people look forward to was whether the China government was going to do, or the central bank was going to give some kind of stimulus to the market, and this especially in view of the fact that you know, there were additional drags to the economy because of the property problem, right? That is definitely the key drag to the economy, or seen as that as such. So when we look at stimulus, I think probably we look at two aspects. One is whether the country or the government is in a position to provide strong stimulus to the economy, right? So second is whether the government is willing or the central bank is willing to give that kind of stimulus, right? So this slide, I'm just looking to address that first part. Is the government or in a position to provide stimulus to the economy, right? Because there's always concern in many emerging economies, right, that the government is not able to do so because they have already got too much debt, right, that they don't think that they are in a good position to spend to boost the economy. Or sometimes they worry that if they do that, the currency weakens a lot, right? Because when you pump new money into the economy, of course, that tends to have a drag on your the trend of your currency, right? Okay. So here I think I just addressed some of this. The top slide basically shows that China, if you look at forex reserves, is actually the world's largest forex reserve country. The country with the world's largest foreign exchange reserves, and that was earned over the past few decades because of its export-driven model, right? When export, you earn foreign reserves. China today has over $3 trillion in forex reserves, right? And they actually have several sovereign wealth funds to manage these forex reserves. Now, the next few high forex reserves countries, you can see that probably like Japan, Switzerland, and so on, they are several multiples lower than China in terms of the size of the forex reserves. Okay, so that's one thing to note, that it is well able to provide stimulus. Second is that in terms of the headroom, in terms of debt versus the GDP, the debt headroom, well, that from this chart you can see that where you compare China against other major developed and emerging economies, right? China's 83% of general government debt against a percentage of GDP, that is relatively still manageable when compared to many of the other economies, right? So probably chief among these, you can see Japan is 255%. Some of the European economies are above 100%. Right? US itself is 103%. Right? So definitely, I think this goes some way to addressing my first point about whether the China government is able to provide stimulus. Second, is the Chinese government and the central bank willing to provide stimulus? That has been a key obstacle over the past 2 years or so, right? And the China president Xi Jinping, right? He was actually he has emphasized some things like housing should be affordable, right? So I think probably what he means is that he doesn't really want to come in and support the property market, even if it weakens a lot, like what happened over the past few years. Secondly, he's been on record and saying that or he's trying to look at quality growth for China. When you look at quality growth, basically, I think what probably they look at is firstly innovation-driven growth, right? High-tech innovation, right? Second, thing about quality, of course, is that you don't want to take on too much leverage for your companies, right? So when you look at the government's stance over the past 2-3 years, they have been more conservative and avoiding a large stimulus package in any sense. But if you look at this year so far, I think both the government, the Chinese government, and the central banks, they have been a bit more proactive, or probably significantly more proactive in terms of trying to drive a pro-growth stance for the Chinese economy. Some of these you can see that monetary policy, the central bank has come out to cut the bank's reserve requirement ratios. What that means is that basically the banks need to hold less cash and they can lend out more to stimulate credit growth. Right? Fiscal policy, right? The central government in their 2024 budget, they have projected a 3% budget deficit. That's among one of the higher budget deficit numbers in recent years. What that means basically is expansionary. The government is looking at spending more and against their revenue, right? Against the tax revenue, they are really going to spend even higher than that to boost the economy. Recent weeks, you also have seen that the government has also come out to lend support to the property sector in what is seen as one of the strongest property sectors stimulus packages over the past few years. Firstly, they reduced down payment ratio substantially for house purchases. So, for example, if you buy your first home now, it used to be that you have to pay 30% down payment for some of the key cities. So actually now it's like something like half, right? It's now 15% for the first home purchase, right? So you can imagine that burden is significantly removed. Secondly, there is basically a 1 trillion yuan in extra funding from the central bank to for SOEs or the various regional governments in China to buy unsold properties, and also supplementary lending facilities to redevelop older houses. Lastly, the government or the central bank has been tightening trading restrictions to limit short selling on the stock markets. And also on the demand side, actually some of the state affiliated funds, like some of the domestic sovereign wealth funds, they've actually done stock purchases to support the market. So you can see that, you know, all this has happened over the past half year or so, right? In fact, if you look at maybe the Hong Kong stock market, or the mainland China stock market, they have come off the lows quite a fair bit. Hong Kong has actually come up from the lows this year to reach a sort of a technical bull market, 20% up from the lows. Same thing for the China A shares market, right? It's come down from the lows maybe about 10% or over 10%. Okay. Right. So the next part I just want to talk about is to give you a sense of A shares versus the so-called offshore markets, because China's main equity assets, they are listed on several exchanges, right? So it's not just the China mainland, which is the A, but also Hong Kong and also some in the US. Hong Kong tends to be, you know, a lot of the SOEs as well are listed there. In addition to the A shares, they are also listed on Hong Kong Exchange as H shares. Then you also see names like Alibaba and you know, Tencent, right? So it is also available in Hong Kong Exchange. Well, the A shares market, which basically is the Shanghai plus the Shenzhen exchanges, probably the few names missing are some of the tech platforms like Tencent, Alibaba, Meituan, all these tech names not so much on the A shares market. Then US is very little, maybe just total is about 6%. And you could see names like some of the tech names as well, electric vehicle names, NIO, right, all this. But by and large, I think you will see that, you know, why A shares. So this is one chart that probably gives you a good flavor that really most of China's equity stocks by value are more than 3/4 of them by value are actually listed on the China's domestic equity markets inside Shanghai Exchange and Shenzhen Exchange, right? Hong Kong is a lot of people, what most of you are familiar with, but if you really want to get some exposure to China's equity market, you know, the key stocks are actually all on the A shares market. And therefore, they offer good exposure to the overall domestic economy, right? And if you don't want to get so much exposure to, you know, the tech stocks, tech platform stocks like Tencent, Alibaba, you know, you just want to get a more balanced exposure to China, mainland China growth itself. Probably A shares is the most suitable one to go for. Right? And if you were to look at, you know, the China regulators, if they wanted to tighten, they wanted to control and bring down the stock markets, probably the domestic companies, they are less subject to China regulatory interventions, right? That over the past few years have been targeting more of the big tech companies listed offshore, right? So because the Chinese government, if they wanted to tighten, they also got to be conscious about the impact of this onto the retail investors on the mainland, right? Which is basically the people that put them in, right? So if they tighten on the A shares, they will probably just prefer to tighten on the offshore markets to make a point. If they tighten on the A shares, everybody's unhappy, right? They don't want to cause that. Okay, so just notional wise, you can see these points easily. Okay, now I just take some time to talk about this ETF that we listed, as I mentioned, in March, right? Some quick points about this. As you can see from the name, right, it basically describes a lot of this ETF itself, right? It's a partnership between Phillip Capital and China Universal, right, which I'll talk a bit about later, which is our mainland partner. The benchmark index is MSCI China A50 Connect ETF, okay? It's a feeder ETF, right? Again, I'll also explain what this means later through a chart. What this ETF basically gives you exposure to is 50 leading stocks in China's A shares. And it provides good exposure because the index is actually designed to ensure that there is good diversification across various key industries in mainland China, right? So not so tech focused, not so tech stock focused, in other words. Okay. Right. Low management fee. I think Sri sort of mentioned before. Let me try this thing to see if it works. Right. Low management fee. Right. Currently 0.01%. Right. And it's a feeder ETF, so it's basically it invests into underlying fund. So that underlying fund also matters. That management fee for the underlying is 0.5%. Right. Okay. Okay. Product summary. So it's suitable for basically some of these. Okay, it's suitable for some of these investors, those who are looking to expose to China's mainland market, right? Those who are looking for transparency, right? So transparency meaning you prefer to buy ETFs rather than individual stocks, and it's convenience also because of course I guess most people outside of mainland China are not familiar with the mainland stocks, so probably a very good convenient and transparent way to invest into China's A shares is to buy through an ETF that invests into some of these stocks. And what this ETF basically offers you is access to 50 leading stocks in the various industries. Okay, so this is just a quick product summary. Benchmark index MSCI A50 is listed on the exchange, right? You can there are actually two counters on the Singapore exchange. One is a Sing dollar counter, and another also, if you happen to have US dollar currency, you can also buy the US dollar counter. Okay, we launched in late March at $1 per unit. Actually, today is more like $1.04 because the market in the A shares market has continued to go up. So actually, the ETF has gained about 4% since then over the course of 1.5 months. Okay, so very easy to buy is at EIP. So yes, so some of these details. I just talked more in detail about the MSCI China A50. Now, this is the benchmark index that is tracked by this ETF. The way that is constructed is as follows, as you see in the flowchart. Basically, what it happened, how they compile is basically you start off with a broad parent, so-called parent index, MSCI China A, right? That is a universe of thousands of stocks that are listed on the China domestic exchanges. After that, MSCI, what they do is that they will pick in this way. First, there are 11 sectors, 11 key sectors. MSCI will pick the 2 largest stocks within each of these 11 sectors, right? So 2 leading securities with the largest free float market capitalization, basically the largest market value stocks. 11 sectors, so 2 times 11, so you get 22 stocks, right? Now, then there are the remaining 28 stocks. So the remaining 28 stocks that make up the total of 50, the remaining 28 are basically just selected from the largest stocks, irregardless of sector, just based on their market value, right? So what you end up with is basically 50 of the probably the largest stocks in the China mainland Asia market. So basically that is how the 50 stocks are compiled. And what you probably therefore end up with is because of this deliberate approach to select leading stocks from each of the sectors, right? So therefore, what happens is that you have a quite good representation across the various sectors. As you can see here, the current constituents of the index based on sector breakdown, you can see that no single sector actually comprises more than 20% of the total index currently. Right? Financials, industrials, infotech, consumer staples, materials, and healthcare. All these are actually key exposures, key sectors, but you also have consumer discretionary, utilities, energy, communication services, property is actually very little, just about 1% of the total. So if you look at the top 10 constituents of this index, right? Some of these you may be familiar, some of these you may not be so familiar, right? CATL is actually a leading, but all these are leaders in their various sectors, right? CATL, electric vehicle battery maker, world leader in that, right? Guizhou Maotai, I think some of you would know about that if you know about Baijiu in China. Foxconn is an unit of Foxconn in Taiwan, but this one focuses on industrial internet. It actually focuses on smart factories in mainland China, so it's really aligned with the general government direction on smart manufacturing, right? For example, so the Luxshare Precision, a key assembler and component supplier for Apple, mainland China, right? BYD, I guess you will be all familiar with that. Right? Yangtze Power is renewable power. BOE Technology, the world leader in this computer displays. Right? So if you look at the top 10 constituents of this index, out of those 50, of course, the top 10, you can see that all these are leaders in their respective fields, not just domestic leaders, but really world leaders. Right. These are actually the 50 constituents, right? In case you are curious to know which are the 50. Right. Now, the good thing about buying into an ETF is basically the index that it tracks constantly rebalances itself. So MSCI, for example, the index provider, they renew and rebalance the index every quarter. Every 3 months in a year, they will rebalance and review the constituents in the index. So they will throw out the smaller, those names that have become smaller in market capitalization, and then they will bring in new names that have become bigger in market capitalization. So basically, they ensure that there is renewal of the constituent makeup over the years as a result. So for example, this MSCI China A50 index, right? If you look at the constituent makeup over the last 10 years, from 2012 on the left till today, which is 2023 December, right? You will see that for example, the consumer staples, the consumer part actually has grown by 5%, 6% over the past 10 years. If you break them down by sector, the healthcare has also increased. The so-called old economy over the past 10 years has gone down by 20%, right? Then communication services and infotech. Communication services, it's not just telcos, but even the newer, the technology platforms part is also classified as communication services. So all that has actually also increased in constituent composition over the past 10 years. Right? So as you can see, this constant renewal of the of this ETF, of the index itself, is basically what also makes ETFs that track the index compelling as an investment for the long term. Right? You don't have to worry about so much because it's basically done for you. Over the past 10 years as well, right? You can see that from 2014 to 2023, what is shown here is basically the various China China-related indexes, right? Well, the ones that have done poorly, right, is actually these two: China A shares, China All shares, and China, right? And basically, these are the two bottom lines, right? The two lines in gray, right? The two lines in gray, they have basically delivered almost no return to unit holders since 2014. And the reason why is because basically stocks like Alibaba and something like that, they are all included inside this China All Shares Index or China Index. Basically, these two indexes include all the China-related shares, whether they're listed in mainland or Hong Kong or in the US, right? They have not done well over the long term. Now, if you focus on A shares alone, right, such as the one in red, right, China A50, right, well, this would have done much better, more resilient, at least over 10 years, right? So you start from 1.0, at least up till now, it gives you at least 80% return, accumulated return over the last 10 years, right? Whereas you compare against something like this, 3.1% over 10 years. That's terrible. Okay, I will probably take some time to cover the structure of this ETF. As I mentioned, the one that we list in Singapore is the Phillip-China Universal MSCI China 50 A50 ETF, right? So that's the so-called the feeder. That's why the feeder fund. Basically, a feeder fund means that it invests most of its assets into the master. The master ETF is the China Universal MSCI China A50 ETF, which is listed on the Shanghai Exchange, right? It's listed on the Shanghai Exchange. And by holding primarily this position for our ETF, basically, however this master ETF performs, we ensure that the feeder ETF will also perform the same way, right? And this master feeder fund model is basically right on the Shanghai Exchange SGX ETF link, which was formalized by MAS and the Shanghai authorities, the mainland China authorities in 2023. So that is how it works, right? So however the master performs, the feeder will also deliver the same results. Okay, China Universal is one of the largest fund managers on the mainland China. Their total assets under management is 1.1 trillion RMB. So that's about probably 150 billion US dollars in assets under management. Definitely as one of the leaders in fund management over in mainland China. So, okay. I promised that I will give you some time to have Q&A. So I think a lot of these I've covered the key parts, and I hope you have some questions for me from here.
Hi, Teng. While we have we give some time for the members of the audience to come up with their questions. We have two on hand right now. The first one is from Ian. Ian is asking, so this is an ETF that invests in China ETFs listed in Shanghai. Is that correct?
Yes, it invests into one, basically just the master ETF. So it just invests in just one line, one master ETF.
Okay. Would you be able to advise if there's any dividend yield for this ETF?
Well, I will break that into two facets. So firstly, the underlying stocks, of course, they would have most of these would have would be giving dividends as well. So that's one. So the underlying 50 constituents, most of them would each give out dividends. Now the second facet is, does the ETF give out distribution for the ETF for this ETF? Basically, we don't have a dividend policy for this ETF, which is to say that we don't really target to give regular distributions to unit holders. It does not mean that it goes nowhere. Basically, what that means is basically the distributions are accumulated in the form of the fund NAV itself. So not to worry, that it just means that your fund NAV, the fund price, basically is incorporating whatever dividends that we collect from the underlying stocks. It doesn't disappear to nothing, nor do we take it from it. Yeah. It just means that, as you will know, right? For example, the ETF, when it gives out distributions, the price will adjust downwards by the distribution that you give out. So in this case, because if our ETF doesn't give out a distribution, basically what that means is the ETF would accumulate that distribution, accumulate the whatever income that we earn from the underlying constituents. Long and short, we don't have a formal dividend distribution policy for the ETF. Although we might still give out distribution, but no official plans. Yes.
All right, thanks, Teck Ling. So what I understand is the dividends are incorporated into the fund itself. So
Yes.
that's where your dividends go. So we have another question from Ian, which is quite interesting. Any advantage of investing in a feeder ETF versus investing directly into the master ETF?
Well, first of all, I don't think you will be able to conveniently invest into the master ETF. The master ETF is listed on the Shanghai Stock Exchange, right? I understand it's also listed via the Northbound Stock Connect. It's also listed on the Hong Kong Exchange, but when either way is listed in China renminbi, right? So it's extremely inconvenient if you wanted to invest. Your natural currency exposure, the natural currency that you have is probably Sing dollar. So by having a SGX listed ETF here on the Singapore Exchange, and this is actually available in Sing dollar, as you can see, trading currency. So basically, it's very convenient. Your Sing dollar, you can straight away invest into the SGX listed MSCI China ETF. That is actually the key advantage that you have, right? You don't have to convert your currency into renminbi, for example. And the other thing I also want to highlight is that the feeder ETF itself is really, really cheap. The management fee is 0.01%, which basically what it means is that you basically, if you add 0.01 to the underlying master ETF at 0.5%, you'll basically be paying almost the same management fee as if you were a mainland investor investing into the master ETF on the mainland.
All right, so next question is, what is the current valuation disparity between the A shares and H shares? A and H share.
Okay, that actually varies. Currently, well, the thing is, I can't give a clean answer to this, and the reason why is because the stocks that's listed on A shares, the A shares on the China mainland market and the Hong Kong market is quite different, right? So the valuation, I think it is difficult to say, right? For example, you don't have Tencent, you don't have Alibaba on the A shares market, for example. Now, of course, if you were to look at the H shares listed on the Hong Kong Exchange alone, of course, because there are SOEs such as Petro-China, right? Or some of the major banks like China Construction Bank and Agricultural Bank, they are listed on both exchanges, right? Then you have the A shares versus the H shares discrepancy. And if you were to just talk about this comparison alone for the A shares and the H shares for such SOEs that are actually listed on both of these exchanges, currently I think the H shares would have a discount to the A shares, right? Which brings you to ask the next question. Therefore, why would I want to buy into these shares of Petro-China or China Mobile listed in domestic China when they are trading at a premium to the H shares listed on the Hong Kong Exchange? Well, quick answer to this is, well, the thing is the disparity between the H shares and the A shares for these relevant SOEs has very seldom corrected over the past few years, right? And the reason why is because there is no clean way of arbitraging between these two markets for the same stock, for the same company. You can't really like buy Hong Kong H shares and transfer over to the A shares and sell over there. That's basically, if you are able to, if you're an arbitrager and if this is possible, then the disparity between the two would quickly correct. But the fact is that there is really no clean way to do that kind of arbitraging, right? So I would say that if you were to look at this angle, there is a problem with that, right? Doubtless to say there is some valuation premium or discount, right? But no clean way to correct that disparity. Hope that answers it well.
Thank Ling. I have another question, interesting question from Matthew. Matthew is asking, is the SJX listed feeder fund hedged for SGD RMB Forex risk?
Quick answer is no, right? So when so what is asking is whether it's hedged. In the quick answer is no, in the sense that supposing a scenario where the China A-shares market does not move in points, it just stays flat over a period, but the RMB strengthens against the Sing dollar, right? The counter that's listed in Singapore, which is the Phillip MSCI China 850 ETF, well, that actually rises in price in Sing dollar terms, right? So there is no hedging. Basically, the price of this ETF in Singapore, it would actually depend on two things. One is the performance of the China, the parent index in China, mainland, in RMB terms. And it also depends on the performance of the Chinese yuan versus the Sing dollar. If the Chinese yuan strengthens against the Sing dollar and the index also goes up, then you actually have a double positive effect, meaning that you gain from both the index rise and you also gain from the currency strengthening against the Sing dollar. Same thing on the other hand, right? If the index weakens and or rather, if the index strengthens but the currency weakens, then there is some offsetting effect. Maybe you don't get the full benefits when you get back to the Sing dollar counter. So there's no hedging.
Okay.
Basically, basically it's the average performance of the 50 constituents in RMB terms, and then we convert it back to Sing dollar.
All right, thank you, Teng Ling. We have one additional question from Ian, which is quite interesting. So, with regard to the current weak consumer sentiment, does it still make sense to have exposure in consumer staple? Are you trying to tell us something, Teng Ling? Now maybe you can elaborate more.
Okay. Well, I guess one of the key things to highlight is that, you know, it is not just a consumer index, right? As I mentioned, this index of 50 mainland stocks, it is actually capturing a broad diversified exposure across the various sectors, right? So, for example, consumer staples plus consumer discretionary, if you just look at these two sectors that are consumer directly links to consumer, that's about 20%. You also have other sectors like healthcare, industrials, financials, IT, right? So those are not so directly linked, although you might argue that it's maybe indirectly linked. Probably, I think it is worth looking at some of the numbers from mainland China recently. Retail sales, for example, has been quite resilient up to the start of 2024, right? If you look at retail sales year on year, which is basically on this basically this chart. It has actually rebounded something like a single-digit percentage positive year on year, right? So which is somewhere here. Maybe it's 7% year on year. So again, if you look at another number such as traffic volume during the Spring Festival, right, versus 2019, right? A lot of all these numbers are actually higher versus 2029 pre-COVID numbers. Right? Railway, highway, and airline are all recovering. Right? Disposable income is relatively stable, right? So I think it may not even be accurate to say that the consumption is poor, or so. I think probably what may be correct to say, in my view, is that the growth of the domestic consumption may be slower than, say, 1 decade ago, or maybe two decades ago. But still, it is still growing year on year in a sense, right? Same thing as exports. So China's exports actually been recovering, right, since the last few quarters, right? And that's actually also partly because of global manufacturing PMI has been recovering. So China exports, which is the brown line, right? So it's actually in positive territory year on year as well. If you see at this last line here. Okay. So yeah. So the key message is this, that it is a structural slowdown. Structural is definitely the word, that China's economy is not going to grow at the double-digit clip that was the case for, say, 10 years ago. But it is likely to grow still. The Chinese government, for example, is targeting to grow the GDP at, say, 5% year on year. So that is still a pretty good number, actually, 5% year on year. Not many economies that are of China's size are able to achieve that kind of year on year GDP growth. Okay.
Yes, thank you so much, Tingling. I think we have time for just one more question for today.
Sure.
All right, so this question is from YLQ. It's a follow-up to the H share versus A share question. Tingling, would you be able to advise if the same H share counter gets a lower dividend versus the A share? I mean, is that something advantageous to the investor when investing in the A share ETF?
Whether if as far as I understand, the same company with whether it's listed on A shares and H shares would be receiving the same dividend per share, right? However, of course, since the H share might be trading at a lower price, right? Therefore, the dividend yield does look higher when compared to the corresponding A share. The yield itself will look higher because naturally, as a percentage of the denominator, which is the share price, then that number will be higher because the share price is cheaper for the H share.
Tingling, before we end today's session, would you be able to give us like, if there's 3 things we need to take away from today, what would those 3 things be?
3 things. Firstly, why China, right? So maybe I just summarize why China. Well, China because of the track record and the critical mass. That's point number 1. Why China A shares? Second point, China A shares because it has a strong performance track record. As you can see, the A shares has a better long-term track record, right? Versus an index that captures A shares and H shares and US shares across the globally, right? So China A shares, that means just focusing on the China domestic market stocks, definitely has a better track record performance-wise. That's point number 2. Well, thirdly, why the ETF that we just listed? Well, because this ETF offers you a quick and convenient way to get exposure to a balanced exposure of 50 of China's leading companies listed on the China domestic markets, right? Which, as you can see here, a balanced sector exposure, an exposure to some of the lead, not just domestic leaders, sector leaders, but some of them even are global leaders in battery technology, in mining, in electronics manufacturing, right? In renewable power. Right? So this index and this ETF basically gives you a quick exposure to many of these companies. So these are the three key points that I hope those listeners will take away from this. Right? Why China A shares, and why this ETF? Thank you very much.
And there you have it. You just heard from Tan Teck Ling, Deputy Investment Officer for Phillip Capital Management, and he discussed the China Asia ETF and why you might want to consider putting that into your portfolio. Once again, thank you so much, Teck Ling.
Thank you so much for having me on. Thanks.
It's our pleasure, and thank you for being a wonderful audience. Till our next seminar webinar, may you have successful trading for the rest of the week, and hope you enjoyed today's session, and do look out for our upcoming webinars and seminars. Thank you so much, and have a great night.